It's now official, there has never been a worse time to buy instead of rent, as it is now 52% more expensive to buy a home compared to renting one. Now, surging mortgage rates that are now close to 8%, along with resilient home prices largely due to the low housing inventory levels, have caused average homebuyer monthly payments to skyrocket in recent months. Looking at this latest Redfin data, we can see that it is now costing new home buyers $2,738 a month on average to buy a home, and this is an increase of more than 21% compared to the average cost of around $2,250 at the beginning of 2023, and is now approaching double the cost that home buyers had to pay during the majority of 2020. Now, it's quite clear that homebuyer monthly housing payments doubling in 3 years is very much not sustainable and has rapidly outpaced the average cost to rent, despite rents also rising over the same time period. And this is especially true when we know that US wage growth is nowhere near this housing payments growth, and in fact, median household income in the US has only grown by 9.7% since 2020. And this doesn't even factor in the rise in the cost of living thanks to inflation, and when we actually look at the real median household income chart, we can see that household income has actually gone down by about 2.8% since 2020 in real terms. And as you can see from this chart, rents have increased from around $1,600 a month in 2020 to now being at $2,011 a month, which is still an increase of about 25%, but obviously nowhere near the surge in homebuyer payments. The last time that the premium for buying compared to renting looked this out of line was just before the 2008 global financial crisis, in which the housing market did crash. However, even then, the premium only peaked at 33% in the second quarter of 2006, considerably lower than the levels that we are seeing today. And this gulf between the cost of buying and the cost of renting is clearly being reflected in the number of homes being sold right now, which has been in freefall for the past year or so, according to this Bloomberg data, and is now close to the lows seen during the global financial crisis as well. And according to the lead US economist at Oxford Economics, Nancy Houghton, the worst is yet to come as the slide in home sales is far from over. Now, this is because recorded sales are based on contracts signed a month or two earlier, and since those contract signings, mortgage rates are up another 0.5%. And if we look at the Mortgage Purchase Applications Index, a forward-looking indicator on where home sales are heading in the next few months, we can see that this index continues to make new lows week after week and is also now comfortably below the lows of the global financial crisis. Morgan Stanley have issued a big warning on what could happen to the housing market if interest rates and mortgage rates are to stay higher for longer, and they do believe that home prices could fall by 5% next year if mortgage rates stay at this current level. And longer term, if mortgage rates remain close to 8%, then the headwinds that this would represent for demand could prove to have a more negative impact on home prices. So mortgage applicants are currently facing the highest cost of borrowing since the year 2000, and this is of course worsening affordability conditions and sidelining many buyers. But buyers are not the only ones who are being sidelined as a result of the current housing market conditions, and in fact many sellers have also been sidelined too. And this is because many sellers are holding on for longer than they would have wanted, and there are a number of reasons for this. Many current homeowners have a much lower mortgage rate locked in compared to the current rate of just below 8%, meaning that moving home right now would result in having to give up this low interest rate mortgage, and it would mean that the person would have to pay more on their next housing payments for their new home. And renting is of course an alternative, but rents have also risen quite a bit over the last few years, as we've seen earlier, meaning that these homeowners may also struggle to afford the rent payments on a similar sized home to the one they are selling, especially if they bought it over 5 years ago. And Morgan Stanley strategists have also warned that eventually these homeowners who are holding on for as long as possible to sell will be forced to sell, and this could lead to a surge in inventory on the market. In their view, even a 5% growth in inventory next year would lead to a 5% drop in home prices by December 2024 if it came alongside zero increase in sales. And essentially, the scenario that Morgan Stanley sees playing out over the next couple of years in the housing market could be a double whammy for home prices, in which the supply of homes on the market rises into a continually weakening demand as a result of rock bottom affordability conditions. And when you actually look at what is happening to the housing inventory levels over the last 6 months or so, we can see that it has already started to rise. From March to the latest data point of September, housing inventory levels have risen by close to 25%, and even though this data is not seasonally adjusted, we usually see inventory levels plateau and start to fall off during the summer. However, this year between August and September, we have seen a strong rise of over 30,000 listings. And on top of this, looking at the current number of housing units that are under construction right now, and will therefore be put onto the market in the next few years, we can see that we are at record high numbers. There are currently 1.67 million housing units under construction, far higher than the levels that we've seen over the last decade or so, and even higher than the previous all-time high of 1.62 million units in 1973. And the number of housing starts, which measures the number of units that have planning permission and are in the early stages before construction starts, is also quite high relative to recent history. The number is at 1.35 million right now, and although this is lower than the peak that we saw in 2022, it is still higher than the levels that we saw during the 2010s. High housing starts and housing units under construction means that there is going to be a lot of housing supply being offloaded by home builders onto the market into a weakening demand very soon. And it's definitely a metric to keep an eye on, but with interest rates looking like they could stay higher for longer and continuing to weaken demand, this could be the beginning of a continued rise in housing inventory levels for the next several years. This would also go a long way to undoing the home shortage that was caused by the post-pandemic madness, and would be needed to get up to the more historically normal housing inventory levels in the low 1 million range compared to the 700,000 number that we are at today. Another major global bank, Goldman Sachs, have also made some interesting statements about the housing market and have lowered their housing market forecast for 2024. So Goldman Sachs forecast the 30-year fixed-rate mortgage to remain elevated for the foreseeable future, expecting it to still be well above 6% going into the year 2026. And when it comes to home prices, they now expect an increase for the next couple of monthly readings, owing in part to the Case-Shiller Home Price Index's delayed release time and 3-month moving average design mean. But they then expect home prices to slow sharply and turn negative into the end of the year, followed by a rebound to below trend home price growth. Now the thing is with these forecasts is that they are based purely on the current environment with the current inventory levels. We've established that inventory levels could be set to rise in the future, and Morgan Stanley do predict that home prices will fall by 1% for each 1% increase in housing supply. But Goldman Sachs are not taking into account any potential increase in housing inventory levels, which we know will lead to downwards pressure on the housing market. And we can see from this latest downwards revision in home prices that Goldman Sachs are becoming more pessimistic about the housing market, and as market conditions continue to change in the next couple of quarters, I believe it's quite possible that they will end up revising these forecasts down even further. Now, trouble in the housing market is certainly on the horizon, but perhaps an even bigger concern is the storm that is brewing in the banking sector, which could lead to a total economic collapse. I cover this in more detail in my previous video, which you can check out on the screen right now. Aside from that, please leave a like on the video and subscribe if you enjoyed it, that does help out the channel a lot, and thanks a lot for watching.